Back in 2015, Bitcoin was trading for around $200, and almost nobody outside a small online community even knew it existed. 2 years later, in 2017, that same asset touched roughly $20,000. Not because a government approved it, not because a bank endorsed it, not because Wall Street decided it was safe. It happened right after Bitcoin survived one of the ugliest internal fights in its entire history. Here's the question I want you sitting with for the next 20 minutes. What if the exact same setup is unfolding again right now in front of us, and almost nobody's talking about it? Most people watching the news look at disagreement inside the Bitcoin community and think, this is bad, this is going to kill it. History tells a very different story, and if you stick with me until the end, you'll understand why some of Bitcoin's biggest rallies have historically started right after moments of maximum fear and maximum doubt, not before them. Before we go further, quick disclaimer. This video is for educational and informational purposes only. Nothing here is financial advice. Bitcoin and crypto assets are extremely volatile, and you should always do your own research and speak with a licensed financial advisor before making any investment decision. Now, if you're new here, welcome to the Wealth Continuum, where we look past the headlines and try to understand the actual mechanics behind the markets. If that sounds like your kind of channel, go ahead and subscribe now, because you will not want to miss what we cover next. All right, let's actually get into it. Let's rewind the clock. 2015, Bitcoin is deep in a bear market. Prices are depressed, hovering around $200, and the general public has already written the obituary. Financial commentators were openly mocking it. Dead. A fad. A tulip bubble. You've probably heard all of that before, but here's what almost everyone gets wrong about that period. Bitcoin wasn't struggling because of some outside attack. Governments weren't the threat. Wall Street wasn't the threat. Bitcoin was fighting itself. Developers disagreed with miners. Miners disagreed with large companies. Large companies disagreed with exchanges. Everybody had a different vision for where this technology should go next. And almost no casual investor even knew this fight was happening behind the scenes. Quick question for you, and I actually want you to answer this in the comments. Before this video, had you ever even heard of the block size wars? Comment below with yes or no. I'm genuinely curious how many of you already knew this piece of history. Because here's the twist. This invisible and glamorous technical argument turned into one of the single biggest bullish catalysts in Bitcoin's entire existence. Nobody saw it coming at the time. Stay with me, because the next part is where it gets interesting. So what was this fight actually about? Strip away the jargon for a second. There was a group that wanted bigger blocks, meaning more transactions could fit into the system at once. There was another group that wanted to keep blocks small, prioritizing decentralization over speed. That's it. That's the surface level disagreement. But underneath that technical debate was a much bigger, much more important question. Who actually controls Bitcoin? Can miners control it? Can software developers control it? Can large corporations quietly rewrite the rules behind closed doors? Can exchanges simply dictate policy because they hold the most user funds? That is the real issue, not block size, control. And this is exactly why this period mattered so much more than people realized at the time. Bitcoin was essentially being stress tested to see if any single group could seize the wheel. Ask yourself this: if one company, one exchange, or one small group of developers could control Bitcoin's future, would it still be worth anything close to what it's worth today? Hold that thought. We're going to come back to it. By 2017, the disagreement had escalated into what people now call the fork wars. You had the rollout of a technical upgrade called segregated witness. You had a breakaway group creating an entirely separate cryptocurrency called Bitcoin Cash. You had regular Bitcoin users forcing a change through something called a user-activated soft fork, essentially regular people telling large companies, we don't need your permission. I'm not going to walk you through the coding details because, honestly, that's not the important part. The important part is what the market learned watching all of this play out. The market learned that nobody actually owns Bitcoin. No CEO can issue a decree. No board of directors can vote on a change. No single headquarters exists that a government could raid or shut down. No company can flip a switch and turn it off. That realization changed everything about how serious investors started pricing this asset. Here's a question worth sitting with for a second. If a massive company like BlackRock disappeared tomorrow, would Bitcoin stop functioning? If a major exchange like Coinbase shut its doors overnight, would the Bitcoin network stop producing blocks? Type your honest answer in the comments. I want to see what you think. Because that is exactly the lesson investors absorbed in 2017, and it's exactly why the next chart is going to make a lot more sense to you. Watch what happened next. Bitcoin went from roughly $1,000 at the start of 2017 to nearly $20,000 by the end of that same year. A move that, at the time, felt almost impossible to believe. Now, I want to be careful here because this is where a lot of other channels get sloppy. I am not telling you that the civil war inside Bitcoin directly caused that rally. That would be an oversimplification. What I'm telling you is something more nuanced, and honestly, more useful for understanding markets in general. The resolution of that conflict removed uncertainty, and markets, more than almost anything else, love certainty. Once investors watched Bitcoin survive an internal power struggle without being captured by any single group, confidence didn't just recover, it accelerated. Institutional capital started paying closer attention. The public narrative shifted from "this is a toy for hobbyists" to "this might actually be a new form of digital property that nobody can seize." Here's something worth pausing on. Before the fork wars resolved, most of the mainstream financial press treated Bitcoin as a punchline. After the resolution, some of the very same publications started running feature stories asking whether it deserved a place in a serious portfolio. Same asset, same technology, completely different narrative. What changed wasn't the code, it was the perception of durability. And that's really the piece I want you to hold on to, because durability, not hype, is what actually moves long-term capital. Quick comment prompt while we're here. Had you known before today that Bitcoin's 2017 rally followed a period where the community itself was split in two? Let me know below, because I think this is one of the most under-discussed facts in all of crypto history. Stay with me, because this next part connects directly to what's happening right now in 2026. Here's where a lot of people are going to feel a chill down their spine, because we are watching a strikingly familiar pattern play out today. Right now, the Bitcoin community is in the middle of a fresh disagreement, this time centered on something called the OP_return debate, along with tension between different node software implementations, commonly referred to as Bitcoin Core and Bitcoin Knots, different developers, different node operators, different visions for what data should and shouldn't be allowed on the network. Sound familiar? Once again, mainstream commentary is framing this as division, as weakness, as proof that Bitcoin is falling apart from the inside. And once again, if you understand the history, you know that framing might be exactly backwards. History suggests Bitcoin isn't falling apart. It's stress testing itself. Again, the market is once again quietly asking the same question it asked back in 2017. Can this network survive genuine internal disagreement without any single party seizing control? And if the answer once again turns out to be yes, what typically happens to confidence afterward? I'll give you a hint. It doesn't shrink. Let's break down what's actually different this time, because it's not a perfect copy of 2017, and I don't want to oversimplify it for you. Back then, the fight was mostly about capacity, how many transactions the network could physically process. Today, the fight is more about philosophy, about what kind of data belongs on a monetary network in the first place, and who gets to decide that as the ecosystem keeps growing. But here's what almost everyone gets wrong when they compare the two. The surface details don't need to match for the underlying lesson to repeat. What matters is the structure of the event, not the specific technical wording. Both are, at their core, tests of whether Bitcoin's decentralized governance model actually holds up under real internal pressure, or whether it quietly breaks the moment enough people disagree. Quick comment prompt for you. Do you think this current node software debate ends up being remembered the same way the block size wars are remembered? As a moment that ultimately strengthened the network? Drop your take below. I actually read these. And while you're typing that out, let me ask you something else. What are you doing while you're watching this video right now? Are you at the gym, commuting, winding down before bed? I always like knowing where this content actually reaches people, so tell me in the comments. This is the part where I think this channel actually adds something most other finance content skips entirely. Institutions do not buy hype. They do not buy narratives from social media. Large allocators like major asset managers, pension funds, public companies, and increasingly entire nation states are not looking for a perfect conflict-free asset. They are looking for systems that can survive an attack and keep functioning anyway. Think about that for a second. Every single time Bitcoin survives one of these internal stress events, it starts to look a little less like a speculative gamble and a little more like actual digital infrastructure, something closer to a piece of the financial system than a lottery ticket. That is precisely why institutional interest has tended to accelerate after major periods of internal stress rather than during calm, quiet stretches. Calm doesn't prove resilience. Surviving chaos does. As of today, Bitcoin is trading somewhere in the low $60,000 range, well off the all-time high of roughly $128,000 it reached back in October of 2025. Its total market capitalization still sits above $1 trillion, meaning it remains, by a wide margin, the largest cryptocurrency on the planet, far ahead of Ethereum in second place, which sits closer to $200 billion. You need to understand this before I show you where this is heading. The current pullback from that all-time high, combined with this fresh internal software debate, looks, on paper, almost identical in shape to what happened before the 2017 breakout. Depressed sentiment, internal conflict, public doubt. That is historically the exact combination that has preceded some of Bitcoin's largest moves. I am not telling you this guarantees a repeat. Nobody can promise that, and anyone who does is lying to you. What I am telling you is that the pattern rhymes closely enough that it deserves your attention. Let's zoom out for a second, because I think this is where a lot of viewers finally connect the dots. Every single major Bitcoin rally in its history has followed a period that, at the time, felt genuinely scary to be invested through. 2015 felt scary. Investors were down, sentiment was hostile, and most people had convinced themselves the entire experiment was over. 2018 through 2019 felt scary too, after the previous peak collapsed hard and an entire wave of new investors got burned. Each time, the fear was real. Each time, the underlying network kept producing blocks, kept processing transactions, kept proving that no single group could shut it down. This is where it gets really concerning for anyone who only pays attention to headlines. If you were making decisions purely based on how scary the news sounded, you would have sold near almost every one of Bitcoin's major bottoms in its history. The loudest fear has, historically, tended to show up closest to the moments right before sentiment eventually turned. I want to be clear again, because I don't want anyone walking away from this video thinking I'm telling you to buy anything right now. I'm not a financial advisor, and this isn't advice. What I am doing is showing you a pattern that is repeated across more than one full market cycle, so that you can form your own better informed opinion, instead of just reacting to whatever headline crosses your feed today. Here's a genuine question I want you to think about, not just skim past. When you personally see negative headlines about Bitcoin's internal politics, does your gut reaction match what the history in this video just showed you? Or does it match the mainstream framing that division automatically equals collapse? Be honest with yourself in the comments. I think a lot of you might surprise yourselves with the answer. You need to understand this before I show you what's next, because this next part ties everything together. If you actually map out Bitcoin's history year by year, a strange rhythm starts to appear. Extreme doubt, internal conflict, public declarations that the project is finished. And then, on the other side of that conflict, a period of renewed confidence that often outlasts the memory of the fear that preceded it. This isn't unique to crypto, by the way. You see similar patterns across traditional markets too. Some of the strongest stretches for stocks have historically followed periods of intense uncertainty, not periods of calm consensus. The difference with Bitcoin is that its conflicts are unusually visible, because there's no corporate press office managing the narrative. Every disagreement plays out in public, on forums, on social media, in open source code repositories, for anyone willing to look. That visibility is actually a strength, even though it often gets mistaken for weakness. A traditional company can hide internal disagreement behind closed boardroom doors. Bitcoin cannot. Every stress test happens in full view, which means every time it survives one, the proof of resilience is also fully public and fully verifiable. Quick check-in, by the way, because I like knowing who's actually with me at this point in the video. What's the weather like where you're watching this from? Drop it in the comments. I read every single one, and it's honestly one of my favorite parts of making these videos. Stay with me, because I want to leave you with something you can actually use going forward, not just a history lesson. The next time you see a headline claiming Bitcoin is being torn apart by some new internal disagreement, I want you to ask yourself 3 questions. First, is this disagreement about who controls the network, or is it simply a technical debate happening within a system nobody can capture? Second, has anything like this happened before? And if so, what happened to confidence after it resolved? Third, are you reacting to the loudest headline, or to the actual structure of what's occurring underneath it? Those 3 questions alone will put you ahead of most of the people reacting to this story in real time. Now, I know some of you are watching this thinking, all right, this is a great history lesson, but what does it actually mean for me, sitting here in 2026, trying to figure out what to do with this information? Here's the honest answer. It doesn't mean you should rush out and buy anything. It doesn't mean this current pullback is guaranteed to reverse. What it does mean is that you now understand something most casual investors don't. You understand that Bitcoin's price and Bitcoin's internal politics are 2 different things, and confusing the 2 is exactly how people end up making emotional decisions at the worst possible moments. Think about how many people probably sold near the bottom in 2015 because the headlines convinced them the project was over. Think about how many of those same people watched from the sidelines as it climbed toward $20,000 less than 2 years later. That gap between perception and reality is where a lot of wealth quietly changes hands, and it's usually the patient, informed investor on the winning side of that gap, not the panicked one. This is exactly why understanding market mechanics matters so much more than reacting to headlines. It's the entire reason this channel exists. I also want to be fair here, because balance matters. It's worth acknowledging that not every internal conflict in Bitcoin's history has resolved cleanly. and not every dip has turned into a rally. Bitcoin Cash still exists today as a separate asset, and it trades for a small fraction of Bitcoin's price, which tells you the market ultimately picked a winner between those competing visions. A disagreement doesn't automatically guarantee a happy ending for every party involved. What it does tend to do is clarify, over time, which version of the network the market actually values most. That clarity is the real prize, even if it takes years to fully show up in price. So here's a fair, balanced way to think about where we stand today. This current node software debate could resolve quietly, with one implementation simply becoming the dominant standard over time. It could also drag on longer than people expect, creating more short-term uncertainty before any resolution. Nobody watching this video, including me, knows exactly how it plays out or on what timeline. What history does give us is a framework for understanding the shape of these events, rather than panicking every time one appears in the headlines. One more comment prompt before we wrap up, because I want to know this. On a scale of 1 to 10, how confident are you that Bitcoin handles this current debate the same way it handled the fork wars back in 2017? Drop your number below and reply to a few other people's numbers too. I love seeing the debate happen in the comments themselves. Let's bring this all together. The lesson here isn't Bitcoin always goes up 20 times after a fight. That would be a reckless thing to promise you, and frankly, it's impossible to know in advance. Nobody, including me, can predict exact price outcomes. The real lesson is this. Every serious attempt by any single group to seize control of Bitcoin has, so far, failed. And every single time the network survives that kind of test, market confidence has historically increased rather than decreased. Every one of these survival events has, over time, strengthened the long-term investment thesis around this asset. History rarely repeats itself perfectly, but it does tend to rhyme, sometimes almost uncomfortably close. The real question isn't whether today's debate looks exactly like 2017, because it won't, not perfectly. The real question is whether the market is once again watching living proof that this network cannot be captured by any single company, government, or group of insiders. And if that turns out to be the conclusion investors reach this time around, history suggests something worth remembering. The biggest moves have tended to come after the uncertainty clears, not before it. Before you go, hit like on this video if you learned something new about Bitcoin's history today. Comment below if you think we're watching 2017 play out again in real time. And if you know someone who keeps saying Bitcoin is falling apart because of this current debate, do them a favor and share this with them, because context like this changes how you see the entire market. Subscribe if you want to keep seeing the market mechanics that most channels skip right past. Around here at the Wealth Continuum, we're not chasing headlines, we're trying to understand what's actually happening underneath them. Thanks for watching all the way to the end. That genuinely means a lot. I'll see you in the next one.